Good afternoon, everyone. Welcome to Reality Bites with Nikki Connors. We've got 3/4 of an hour. It's going to go very fast today because I've got a guest that is so full of information and experience that you're going to find it very interesting. It's Mr. Gilbert Robertson. He is a director of BDO in Marlborough, Tasman, and of course BDO is one of the most respected accountancy firms throughout the world, actually, with over 1,700 offices. So a lot of experience there, and we're going to get through some of the examples of some of Gilbert's clients over the last however many years that he's been in business and been advising clients. So good afternoon, Gilbert, all the way from down country. How are you today?
Yeah, good. Thanks, Nikki. Look forward to being part of your chat today.
Oh, brilliant. So not only is Gilbert a very highly experienced accountant, he's also a client of ours and has referred quite a number of clients over the years. And so today what we want to do is look at some of the examples that Gilbert can give us from clients and why they chose investment property or why Gilbert felt that investment property was right for them. But first of all, let's go back to basics. Let's talk about the options that most New Zealanders have to get a passive income in the future. And there's not that many, is there, Gilbert?
No, not really. And a lot of them evolve around having very high cash flow or actually having money in the bank to be able to invest somewhere else.
But with money in the bank, I mean, let's face it. What's the average interest rate at the moment? 2.5. For savings, 3%. I mean,
Yeah.
So how many millions would you need in the bank for someone that is retiring that is going to be inflation proof? Because of course, cash isn't inflation proof. So what do you think? On $100,000 maybe as a passive income, how many millions do you think someone's going to need?
Well, that's a lot. It's a big number. But yeah, so certainly that comes down to strategy in terms of what you need to invest in. But it would be millions of dollars that you need in the bank to make it worthwhile.
And I'm sure that as successful as most of your clients are, that there'd be very few that's got that amount in the bank.
Yeah, and that's the problem with today, right? Life has got expensive, and it's hard to just pay the bills some days. So therefore, having a different strategy in terms of saving cash and using other means to grow an investment portfolio is beneficial.
Okay, and what about superannuation and KiwiSaver? I mean, I don't see that many people coming to us over 15 years of doing this that have got, I think, on one hand, I can count clients that have got over about 300,000 that has been accumulated in super and or KiwiSaver.
Yeah, and I think most of us would look at our KiwiSaver balances these days and go, actually, the return's been negative, so that's been scary for some of us. But certainly, I would take advantage of. It's a good way of taking advantage of. If you can get your employer putting X% into your KiwiSaver and matching you, then that's great. And then there's a little bit from the government to top it up. So certainly, that's one strategy you have. But certainly, a lot of clients don't have a lot of money by the time they come to retirement.
No, and of course the trouble is that it's wonderful that we're living longer, we look younger, we've been travelling. So when you get to 65 and you know that you've got a longer life and you've got a full life ahead of you, it does take more money than it did our grandparents to see us through.
That's right. Yeah, it does.
And what about stocks and shares? How many, do you have many clients that have achieved a passive income through investing in the share market?
We do, but generally they have had the fortune of being able to sell or inherit. So they might have sold a business, they might have inherited some money, but generally a lot of clients haven't really had the opportunity to build those portfolios. And so therefore what we're seeing is they need a good pot of money to be able to do that. And in today's current environment, that return on those investments has come right back. So therefore, generating an income off some of those investments can be tougher than normal. But in saying that, that's off the back of probably 2 or 3 years of really good returns. So
Right. Yeah.
it all depends on your portfolio.
And I think the catch-22 with all of these forms of investment, and you and I both know, and I know that you give your clients this advice as well, that a good, well-rounded portfolio is a healthy portfolio. But then we come to the other option for building the passive income or paying off your mortgage, and that is property. So even though there's been a lot in the press at the moment, and the press do love to give you horror stories and depressing news, what's your view on investment in property?
Yeah, so investment in property can work. And the reason why it can work is that sometimes we don't have money to be able to invest in an investment, but we've got our home, which we've built up some equity, whether it's through paying the mortgage down or through the value of the property going up. So, and sometimes it's very hard to use that equity, but buying other property or buying rentals is a good way of using that equity to get us ahead. And so therefore it's an easy way to get into other types or other investments without having cash.
Yeah. And I mean, let's face it, the banks will they won't loan for you to put money in the bank at 2%, and they won't loan you money if they know that you're going to be putting it on the stock market. The only thing that you can borrow against the equity on your home is property. So it remains, doesn't it, to be a standard. It remains to be a solid investment option long term.
Yeah, totally. And I haven't come across any interest rates yet, or it's very hard to be able to borrow money for cheaper than you're actually going to invest it in, right? So it's always the bank's making a margin. So therefore you're paying the margin. So you can't really borrow that money and invest it in a term deposit, or I haven't seen many or any situations like that. Turns out. So therefore borrowing money to invest in a property is potentially one of the only ways of being able to do that.
And it's good debt, isn't it? I mean, I remember when with my parents, and they didn't like to borrow against anything and have credit cards, but if we have to get ahead nowadays, and as you said quite rightly, it's very expensive. It's the cost of living. It's not just in New Zealand, but it's around the world. It's about commodities. The cost of a loaf of bread from 10 or 15 years ago has gone up because of the ingredients, the people that are baking it. And that's got to be the same with property as well. So good debt is worthwhile if you're taking it for that long term.
That's right. Yeah. So borrowing money against a rental property is better debt than borrowing money to buy yourself a house. So generally, a lot of us think our own home is an asset. Well, reality is it's not an asset because it's not generating income for us. But that's where a rental property But what we can use the equity in our house to actually use that to invest in another asset, which is a rental property.
Yeah.
But still, you've got to look at cash flow, right? Cash flow is still king. So therefore, you've got to make sure the numbers stack up. The rental property is generating a cash flow to be able to fund the mortgage, the rates, the insurance, and all those other outgoings. But it is a good way of being able to generate some cash flow or generate some value down the track.
Yeah. Do you know, I have clients that have come out of relationships and marriages and have a certain amount of money, and they're really wanting to get that lifestyle back that they have lost because they've halved everything. And the first thing, especially for women, the first thing they think of if they've got children is, I've got to buy a house. I've got to get into my own home, which means that whatever funds that they've got is now put into what I consider a black hole, because there's the mortgages that may not be paid off, that it's interest rates, whether it was 21% when I started, 5.99% long term now. It is, for someone that's starting again, it's a huge responsibility, and it really eats into your lifestyle. So you've touched on something which I feel very strongly about, is that if you're starting again and you do have a lump sum of money, it probably is better live where you want to live, because if you're starting again and you've got half the amount anyway, you're not going to have the same lifestyle and the same level of housing and homes that you had. Rent where you want to live and put it into something that's going to build up the equity to give you the home that you want in the future.
That's right, and certainly when you got young people talking to young people, like they might be in the early 20s, they've just got a good job, they're coming out of varsity, starting to get a good job and good salary going. So I talk to them about living as cheaply as they can, like whether it being sharing a flat with some friends and then putting their money into rental properties, or putting their money into rental properties. So living in their own home is not necessarily going to create the equity or longer term cash flow that they actually want.
So just going to some of the examples then of some of your clients. So there must have come a time when you're looking at your clients and they're sitting down and you've got their accounts for the last financial year and you see what they're paying out for the bank on their own mortgages. Can you give us some examples of where you have said, look, this is really the way you should be going?
Yes, over the last, so many years, we've had a number of clients when we sit down and go, what can we do differently? How can we sort of get ahead, either to pay the mortgage off or actually look at other avenues of investment? And generally, they've got a business that's going okay, or they've got an income that's pretty good and they've got cash flow, but it's enough to get them through. And have a little bit spare, but it's generally not enough to save a lot of money very quickly. So therefore, they can't just go and invest in a share portfolio or put on term deposit and get that return straight away. So what we generally do is we look at their personal situation, look at how much equity they've got in their house, can they afford to top up a mortgage if need be? So therefore, okay, what sort of properties are out there? And that's when we talk to you and Trevor, your team at Propeller, what sort of opportunities are out there for our client to have a look at property around the country, sticking to your philosophy of the three main centres, Auckland, Hamilton, Christchurch, and then going, okay, well, how can we make this work for the client with the longer term view? And the key with property or most investments, you do have to take that longer term view.
Yeah.
So, and this is where, and some of the clients we're talking to in their early 50s, it's like, okay, well, you've got 10, 15 years, so we need to make sure we make the most of that 10 to 15 years, and property is one avenue of that. Whereas in their 40s, early 40s, they've got a bit more time, so they've got sort of 2 10-year cycles in them. Whereas, so trying to get them started as early as possible on that property journey or investment journey doesn't always have to be property.
No, well, it doesn't have to be property. You're absolutely right. But of course, as we're going into our 50s and early 60s, and we're now looking at the tail end of the baby boomers as well. I read something in the paper recently about the US and the fact that the baby boomers have now all of this property and all of this equity, and they're looking to retire. And what are they going to do with it, with all of this equity and all of this housing? But the question in New Zealand, and I'm sure it's over there as well, that it sounds great, but how many of us are going to retire with a mortgage anyway and aren't going to be able to afford to live in their own home? So, I mean, what percentage of your clients that are in their 50s or early 60s have still got a mortgage?
Oh, I'd hate to guess what percentage, but it's an alarming amount of people that are looking to retire with a mortgage or some sort of debt, and that they have to service going forward. And the difficulty thing for them is having the cash flow. And what we're seeing is people working longer or owning their businesses longer and not necessarily letting go. And therefore, it's not necessarily doing, and especially when you've got family-owned businesses, maybe the parents are holding on a little bit long to the business because they've got their debt servicing needs, and they haven't been able to get it to where they needed to be. So, and that, to me, that can be quite sad as well. But there is a lot of people out there that haven't quite got their debt levels under control by the time they get to retirement.
And there's going to be there's going to be a lot, as I said, as those baby boomers come through as well. I think there's a question, and if you wouldn't mind reading that out, sorry.
Yeah, let me see if I can work technology. Was there anything in the budget that property investors should be worried about? That's a good question. The only thing I'm worried about at the moment is that the trust interest rates going up to 39%. That would be my biggest fear at the moment. But from a property investment, I haven't seen anything that I'd be worried about in terms of investing in property.
Well,
Have you seen anything, Nikki?
yeah, for property investors, I mean, the budget was a waste of time anyway. But
Yeah.
for most New Zealanders, sorry, I'm going to say it, it really was a waste of time. So that brings us on to something else as well. You know, when we're talking about legislation and tax. Now, one of the I suppose one of the fears that people have when they come to us is the fact that 5 years ago, 3 years ago, you could get your tax on the depreciation on the chattels as you got paid, which means that there was extra in your pay packet to top up that property. And that's not necessarily the case at the moment. But there is still tax savings. It's just different, and I'm going to ask you about that. And I'm also going to ask you about old property versus new property under new legislation as well, because I think that's very important for those people that have had an investment property for 10, 15 years and they think that it's ticking over okay. There are quite a few negatives with that now. So let's just go back to what tax opportunities that there still are under the Labor government.
Oh.
Sorry, I had to throw that in.
That's a loaded question. Well, the thing is at the moment, with the way the legislation, the rules, tax rules are shaped, is really buying new property has a big advantage over old property. But old being anything that was built prior to 27th of March 2021.
Which is
So
crazy,
anything,
isn't it? That's considered old property.
yeah, so 2 years, so it's only 2 years old really. But and it's interesting, I've had myself and friends caught with buying property like only months before that, and it's like, how did they pick that date? So therefore, you get the interest deductibility if it was built just before that date, or you had a mortgage just before that date. Or any time before that date, you've got the amount of interest you can deduct against that, the income of that property gets reduced to nothing by 31 March 2025 or 1st of April 2025, because you can still claim 25% in 31 March 2025 year. So after that, it's 0%. So then you look at the strategy of going, okay, well, do I need to change that property for a newer property so that I can have the interest deductibility? And when we talk about interest deductibility, it's for the next 20 years. So they've limited that as well. So it's only for 20 years. So it means that you can on-sell that property within the next 20 years, and the next buyer can get that interest deductibility as well, which can be a huge advantage.
Well, it can be, and that's another reason why, under the definition of a new property, if you are an investor and you're going out yourself and you're buying something that's already that has been built after that time, surely it is more of an advantage to buy a property that is from 2021 forward, because you've got that part of that 20 years. As opposed to buying a property that may be 5 years old that is no longer considered a new property, and you've got tax obligations.
That's right. Well, and again, it comes down to my earlier comments about cash flow, right? So if I had an existing property before that date and I've owned the property for maybe 5 or 6 years, I wouldn't necessarily rush out and go and sell that property. I'd actually sit down and go, okay, how much cash flow am I getting from this? What is the value of it? Could I, or what happens if I cash that property in now and go and buy a new property? Does that give me good equity? Could I buy 2 properties with the equity that I've got in the existing property and then leverage that to actually get more debt and get the interest deductibility? So I've also done that with clients as well. Okay, what happens if we sell that one property and maybe buy 2 properties? Is that possible? And sort of try and spread our wings a little bit. And that's where I like, doing. A lot of people don't like investing outside where they live, but generally,
No.
investing in the good regions and not having that emotional attachment is far better. And that's where having diversing yourself into different markets can help as well. So Auckland is performing slightly different to Christchurch at the moment. Christchurch has been appears to be a bit of a superstar and has ignored what's going on in Auckland and Hamilton and places like that. But all the rest of the country, and Christchurch seems to be still forging ahead
Oh,
with a little bit
it's
of growth. But
brilliant.
yeah,
Totally undervalued, Christchurch. I say to my clients, just like I said 7, 8, 9 years ago, get into Hamilton, because this is the reason why Hamilton is going to go like this. And it has. My clients have made a lot of money investing in Hamilton, and it's the same with Christchurch, isn't it? I mean, we're seeing this the land, the cost of land going up, the limited ability to find the right amount of land to build houses on, and of course the need for housing, and so with rental. But I agree, spreading that risk is very important, and it doesn't matter where you are. If you are investing in stocks and shares, are you going to see where the head office is of the company that you've invested in? Of course you're not. It comes down to being the fact that it's a business, and that's how it's got to be treated.
That's right. That's right.
So just going back to the tax, sorry to have interrupted, and
that's right.
Going off on a tangent as I tend to do. But, okay, so you can't get the tax deductions as you get paid anymore, but there still is the opportunity for tax deductions. It's just in a different format. So if you wouldn't mind just explaining that and what that tax deduction could be used for.
So what happens now, in the good old days, you used to be able to get that loss offset against your personal income. You can't do that anymore. So what that happens is that loss builds up there until either you start making a profit on that property, or you might sell that property and made a capital gain on it. So that's when you start to use it. So that's where you've got to take a longer term view on this. So you're not necessarily getting the tax deduction straight away, but you could potentially get it or use it down the track.
Okay, so here's a question for you. If I had a property, and of course I've bought brand new, and with brand new property, if you had to sell it after 5 years, you don't necessarily pay the tax on that profit. But let's just say that I haven't got a good reason to sell that property, but I want to sell it after 5 years. Can I use those losses against the capital gains, the tax on that profit? Am I able to offset one with the other?
Yeah, so good thing is if you sell that property, if you bought that property after 31 March 2021, or sorry, 27th March 2021, and you sell that property after 5 years, you don't have any tax. You can make as much capital gain as you want. You won't have to pay any tax on it. It's only if you sell it within those 5 years. So therefore, it's a matter of what comes down to how we treat the losses that you've accumulated going forward. I think I'd have to look at this, but maybe I should have done a bit more research. But given if you've got multiple properties, you can sort of offset. Have a loss offset with the other properties, but I'd need to double check that one. But certainly, if you're selling that property after 5 years, you don't need to worry about any tax on those gains.
I mean, that once again, we come back to why new property. What a lot of people don't realise as well, Propeller sells most of our just about all of our property off the plan. So it could be built in 6 months, 12 months, a year, 18 months away. But as far as the tax department's concerned, the clock starts ticking when you confirm on that property. So what that means is that if it takes a year to build and in 4 years' time you want to sell that property after you've settled on it, that is considered 5 years. Is that, am I giving the right information there? I know.
No, I thought that was 5 years from settlement, actually.
Okay. We'll talk about that. We'll talk about that off.
One of us is right.
Yes, that's true. We've got a 50% chance, either both of us. But so let's now look at your personal situation, if you don't mind. When did you decide that it was a good time for you to invest?
I invested quite a few years ago. Not early enough, as far as I'm concerned. I wish I'd done it earlier. And knowing what I know now, hindsight's a beautiful thing. It would have been beneficial to do it back when I started with my first rental property when I was about 20, but for various reasons and the way I sort of structured it with the bank, I had to sell it to buy a family home because we were having kids and everything like that. But
Yeah,
knowing
but
what I know now, I wish I'd kept the rental property, right?
yes,
And
but
did
at
both.
least you had that asset to be able to do it, and it kept up with inflation, so that you probably had a bigger deposit than if you'd been saving anyway. I mean, you're right,
That's true.
hindsight.
Yeah. But I started that journey, a number of years ago, and since then have accumulated a few properties. And to me, I look at a combination of things, area and where the area it's been built in, and that's generally come through recommendations from your team. And also cash flow on that property and making sure that it's affordable and looking at how much I can afford to top that mortgage up if I need to. But generally, it's been pretty good in terms of what I've needed to top up, or in some cases don't need to top up at all.
And that brings us on to another question that we get a lot. And obviously, interest rates, 3-year interest rates were the number of the banks at long-term 5.99. Clients that have had it for or getting a term of 6 months or a year are in the 6%. Before that, last year it was in the 2s. This is holding some people back. This is the fear of what they have to top up. Now, this is something that really everyone who is thinking about investment property, and if that's the fear, they should be making a note of this now. So this is something that we do as part of how we work with our clients. But let's get it from an accountant. So what are your recommendations for taking care of the top-up? Because yes, there is a top-up. Remember, if you're buying this property and you're using a bit of the equity in your home to guarantee that deposit, it's effectively 100% borrowing, 100%. Now, you can't get any other investment where you've got using other people's money for 100%. So at the moment, unfortunately, there is a top-up. Now, in a year's time, you talk to Tony Alexander. I believe as well that the interest rates are going to go down. The average interest rate in New Zealand over the last 10, 15, 20 years, Gilbert, have been about 5%.
Well, I remember, I don't know what the average is, but I remember when it used to be a lot higher.
Yeah, I do too. That shows my age as the tail end of the baby boomers. But I mean, you have to expect that you're going to top up that property by something, and for me, it's like a forced saving. But let's get your tips on how you can supplement that so that it doesn't interfere with your day-to-day lifestyle.
Yeah, so my theory is that people have always got accumulated expenses that they don't really need. So I would look at the lifestyle that you're trying to live and go, okay, what can I sacrifice now so that down the track I've got a better lifestyle? Because that's what it's all about, right? So I get to retirement and I can actually afford to go on holiday. I've got no debt. I've got some income coming in to enable me to do the things I want. And quite often we get too hung up on, particularly when we're in our 20s and 30s, we get too hung up on trying to create that lifestyle and have the freedom. But the reality is, if we worked hard and set goals and saved the lifestyle for later, then we could actually afford to do these things earlier. So I'd look at the little things and go, what can I cut out of my weekly budget or family budget? For some of us, it might not be a lot. There's not a lot of fat in it, but there's always one or two things like, could I forgo a coffee a day and get me that $50 a week or whatever to actually top up my mortgage? Or because sometimes that's all you're talking about is $50 to $100 a week to be able to top up that mortgage.
Yeah, and sorry.
No, go, sorry.
No, well, I was going to say as well that especially if you're in your 50s, and you've been paying off your mortgage, say for 15 years, for instance, and you've still got another 15 to go. One of the things that we say to our clients is, let's go back to the bank and extend that back up to 30 years. It doesn't mean that you've got 30 years to pay off that mortgage. It just means that your outgoings are going to be reduced because the loan is now over 30 years. And so that saving can go into a property to top up at a property that you will sell potentially in 10 years and have your whole mortgage paid off anyway. So you've already saved, but it can be quite substantial.
Yeah, that's a good advice, Nikki. So if you can, reduce payments. One thing I like doing is, if you need to buy something, is buy it on interest free. If you can move some debt to interest free debt, but make sure you pay it off in time and plan that in your cash flow as well. So if you need to buy a car or some furniture or stuff like that, TVs, buy that interest free through GEM. Generally, most retailers doing, but certainly extending that debt that you've already got out, so you can use that debt servicing to service good debt, or what we call good debt when you're buying a rental. Then it makes it, then that's ways of doing it. We've actually got a question come in that said,
Yes.
how do I get into a property market if I'm struggling to accumulate a deposit? Well, from my point of view, that there's a number of different ways of getting property, and if you're lucky enough, you might have parents that have got equity in their house that might be able to help you, use the equity in their house to fund a deposit. But if you're just doing it off the bat and you've got no property or no connections to property at the moment, and you're trying to save, then it's just a hard grind in terms of trying to put every dollar away you can as quickly as you can.
We help a lot of clients and their children. It's been over the years. I mean, you can imagine 15 years we've seen clients that have come in with their teenage children and then come back with their children in their 20s and doing exactly that, Gilbert, by gifting against equity in their home as well. And I think, once again, as you're talking about baby boomers, this is something that we can pass on to our client, to our children, without actually interfering with our lifestyle as well. So there was another question.
Yeah, this one is, I have a property that is 5 years old. It's worth about 600. Is my property liable for tax under the new regulations? How do I go about calculating it? So yes, you'll be liable for, well, it's slowly being phased out. So you're probably still within the phase out stages in terms of how much interest you can deduct, but you will be liable for the tax on the income less the rates, insurance, and other sort of repairs and maintenance and other expenses. So then you take that and times it by well, it depends if you've got it owned in a company, trust, or in your individual name. But if it's owned in a company, you'd take the flat rate of 28% on the profit left after that, without the interest. And then if it's in your personal name, depends on how high your income is, depending on what the tax rate would be.
Okay. I just want to go back, to the ways that you can top up the properties, the investment properties as well. So we've looked at extending the life of that of the mortgage up to 30 years. It's interesting how many people obviously we want to get our mortgage paid off faster. But once again, I'm looking at clients where they put in an extra $1,000 a month into their home, and the reality is it's still going to take 15, 20, 25 years to pay off their mortgage. And the amount that the bank makes in interest is it's appalling, it's obscene. So one of the things that we say there as well is pay the minimum that you can, principal and interest on your own home, pay the minimum, and that saving, once again, can go into topping up an investment property that's going to get your home mortgage paid off faster. And the other part of that is that in the cash flows that we do for our clients, we also put in a little bit extra of borrowing to act as a buffer, and it could be revolving credit, and that's until interest rates potentially go down. So over the next couple of years, it may be an extra $20,000. Now, sounds a lot, but if you're getting the loan on the investment over 30 years, that $20,000 it actually makes not a lot of difference to the bottom line, but it makes a huge amount of difference if you're able for 2 years to top up that property by $100 a week. Gilbert,
Yeah,
is there? Sorry,
and the
go
other
on.
thing too, remember, Nikki, is that, how many of us, like on average, what does a property go up? Maybe if it went up even a minimum of 20 grand a year, 20 or 30 grand a year, but ideally it might be going up 50 grand a year in terms of capital value. How many of us can save that sort of money per year on our salaries that we've got at the moment with the living costs? So if we can use the money that we're paying off on our mortgage and extend that out and use that to grow our capital by that 20 to 50K a year and sell the property in, I don't know, maybe 5, 10, 7, 10 years, and we've accumulated some equity that we otherwise couldn't save, we're going to be in a far better position, right? Might not be, some people are seeing at the moment that might not be as much as what they'd hoped for, but the reality is they wouldn't have saved as much money or as they've accumulated in the equity that I've just
Yeah.
realised.
So we're coming close to the end of our time. One last question from me. Just tell me, we have clients that say, I've got a bargain. I've bought an old property. I've got a bargain. It's 20 years old. It costs this. In reality, when you're looking at the client's situation, the cost of something that looks like a bargain, that's an older property that needs work being done to it, does it justify itself against having a new property? I mean, I know I'm doing a large, giving you a big question there, but...
Yeah, I would say it more comes down to cash flow and looking at, I'd look at the cash flow of that property, but then go, okay, what happens if I sold that property? What sort of other properties could I get in? What's the cash flow of those properties? So it's around crunching the numbers and going, okay, what strategy or what's the best strategy for me or for my property portfolio? So yeah, certainly we've had clients looking at, they've had property, some older properties for quite a few years, and then they've looked at, okay, well, maybe now's a good time to cash out. I've got good capital gain off that, and so therefore I can go and get myself into some new property, or maybe pay off my debt on my existing home, and then use the equity to go and buy some, borrow again, leverage the new property and get into some more property.
Great.
So
We got another question?
it can be a good strategy to look at in terms of, do I need to upgrade? Usually, so the question is, usually for a new build purchase, you recommended how long does it take to receive a positive cash flow rather than requiring a top up? Well, again, that all depends on the property, the area it's in, the rental it's getting, and the interest rate that you've fixed it for. So it's not an easy one to answer.
And at the moment we've got some property that, in fact, because it's sort of considered a semi-commercial in that it's managed apartments, for instance, that with a guaranteed return, that they are cash flow positive after about a year, and the top up is not very much at all. Now, if interest rates go down, again, it depends, as you said quite rightly, on the price of the property and the rent that it's getting. Another reason why it's always good to invest in those areas where you've got a more aggressive rental return in that respect.
Yeah, well, because I've got one in Hamilton, Nikki, that I bought through Propeller, and that's actually cash flow positive and can and it is actually helping pay the deposit on the next property. That's that cash flow positive, so I'm not having to top that one up either.
No, and it's interesting. We talk about the purchase price and the rental, and I'm going to give you an example. So Christchurch, for instance, as we said, it's a fast growing, it's an exciting place to invest, but rents haven't caught up with the purchase price of properties, which are going up. So, for instance, a 4-bedroom house in one of the most dynamic areas in New Zealand are the rent's only about $650 per week, and that's on, say, an $800,000 property. But we've also got $1 million properties, which is like a house and an income, which is a 3-bedroom house and a garage and a 2-bedroom unit and a garage that can be subdivided in the future. Now, the cost of it is $1 million. However, the rent is $1,070 or $1,100 a week, which means that even though it's more expensive, the top-up is nowhere near the top-up on the freestanding house that's at a cheaper price at $650 a week.
That's right.
So is there any more questions at all? This has been fantastic. Thank you so much, Gilbert. If we've got any questions. Now, of course, with Propeller, you're dealing with senior consultants only, all with a great deal of experience that have gone through the various cycles that we've seen both nationally and internationally, and can look at ways in which to protect your cash flow when situations come along. And one hopes that there's not going to be anything again like COVID, but how you can retain your property. One of the things that we do is ensure that our clients are surrounded by the right sort of people, accountants, solicitors, mortgage brokers that are specialists in this. And I've got to say, it has been great working with you, Gilbert, and with your clients. We hope that this relationship will go on for a long time. So thank you very much, Gilbert, for your time.
We just got one last question, Nikki. I see it just pop up, so just in time. How do I know I'm using the right accountant?
Well,
it's about, yeah.
Go on. No, as an accountant, you say first.
Well, I was just going to say, if depends on if you feel like you're getting the right advice and they're helping you looking at different strategies and thinking outside the box a little bit in terms of how you can do stuff or get ahead in life. And
that's actually a very good question, because that also can apply to mortgage brokers. Now, most mortgage brokers, or a vast majority of mortgage brokers, are used to dealing with mortgages for your home, for residential home purchases. With investment property, there are other things to consider. There are banks that will take certain profiles of properties over another. We talked about this buffer, for instance. So that is really important, that you're talking to a specialist as well. So when you are looking at property investment, I think, Gilbert, and you can say this, those people that try and do it themselves, I would never try and do my own accounts. I actually use BDO in Auckland. Why would I do that when I should be going to the specialist in what I'm trying to achieve? And
also, we've seen people try and do it themselves, but quite often they don't understand the tax rules and some of the intricacies of tax, and they get themselves into a little bit of trouble, and then they need the accountant to help them out of the trouble. So having an accountant sort of help you through that from the start can make a big difference. And I totally agree with the mortgage broker. I think mortgage brokers can add a lot of value in terms of best way to structure your debt. Same with conversation with the accountant, in conjunction with mortgage broker, best ways to structure your debt, best ownership structure, all those good things. Because sometimes the banks, how hard is it these days to talk to someone within the banks and have that relationship with someone? And that's where using a mortgage broker can be a huge advantage.
And a mortgage broker that has a vast amount of lending as well, because if you are dealing with the banks on a regular basis and you're dealing with millions and millions of dollars worth of spending, you're more likely to be dealing with senior credit in a bank. So that makes a difference as well. And we always say it is not a do-it-yourselfer. You've got to have the experience of the experts, because you don't know what you don't know.
That's right. Yep.
Well, thank you so much, everyone. If you would like to make an appointment, remember our consultations are free with one of our senior investment specialists. Take you through the opportunity, whether you can invest in property, and then from that, we will work through and put together a strategy and identify the right sort of properties that are going to suit what you're going to achieve or what we've identified that you should be achieving throughout the next 10 to 15 years. So we'll put up the information on how to contact us. Basically, it's 0800 81 81 91 or info@propellerproperties.co.nz. Why not do it? Why not find out what you can achieve and how quickly you can have your mortgage paid off, or you can start with your passive income? Thank you so much. It's been a pleasure as always, and I look forward to next month when I'm going to be talking about the pitfalls of managing your own property with one of New Zealand's top property managers. Thank you and have a lovely day.